This is what analysts expect. So essentially, we make profits if we buy a future that will be better than what analysts currently expect, because what analysts currently expect is already incorporated in the price. Analysts expect the revenues to keep growing. But you can see here that essentially for the next 3 years, analysts expect the net income to be completely flat. So if we have an intuition, that these margins that we showed previously, that here sucking at 10%, are actually too low because there are some levers that could increase the margins, then what seems expensive at 50 times earnings, it is actually cheap because the earnings would explode if the margins increase. So that's why I like to jump, zoom in and zoom out. And for instance, understand, okay, what could be the what is the steady state? What are the levers? Tesla is the sum of what we already know and the big future bets. What we know for with more certainty is essentially the car business. And then there are these options that are going to be executed, but there are some of them that are already being executed, others that are just far in the future. So I think the best approach is to evaluate Tesla for what it is already right now, and then consider the long-term bets like the Dojo, the Robotaxi, all of that stuff, just options that could be executed, but for the moment, they don't really add to the valuation. Because if you start adding points that will happen in 10 years from now, I think you are adding a lot of noise that could happen and will have a lot of value in the future. But I think you get distracted to, okay, what is the company worth right now? So far, I would say Tesla is primarily an auto business with this component of energy and services that is going to be, that is already starting to generate, finally. Probably they are now at the inflection point where they start impacting more and more. So essentially, I would say Tesla is worth the automotive company, the automotive sector, plus energy and services, which I would mix together. And that is what Tesla is worth right now. All the other things are options for the future, which I want to have, but I don't want to pay for them. So as long as automotive plus energy and services make some sense, I know that all the future options are for free. Are not for free, but let's consider that. So that is how I would say, if I pay a fair price for the two core businesses, assuming that energy and services work together, even if they're not too, they are services more related to auto, okay? But as a cluster, I see those contributing to the margins much more than the car business. The car business is used as the access point for then to sell services, and the energy is independent, but it is a higher margin business. So as long as these businesses that we already know, that are emerging in the numbers, we pay for them a fair price. All the other stuff that comes in for the future is essentially for free, and at that point, you're not overpaying. Because I think here the goal is not paying too cheap, is not making a mistake in paying too high.
Throwing a curveball, I just calculated what Damodran is expecting, and he's expecting 22.4% CAGR for 10 years.
In revenue growth.
Yeah.
So you see, and I remember his margins expectations were not that high. Here is the Damodran estimates. So the revenue keep growing at 20%, and then he expects the EBIT margin to be like 13%. So you see that these numbers are, in my opinion, these are like very base number. It's like for Palantir saying 25-30% CAGR with 25% EBIT margin. So it's like those assumptions that are very very broadly.
Wait. Can you
in
take
the
the Palantir comparison again?
So, like for Palantir, my approach has always been, okay, what is the natural steady growth rate of this company? What is the natural margin profile of this company? And then you add more considerations the more you understand the company. And with Palantir, I always kept thinking, okay, this company, in terms of revenue, should structurally grow 20-30%. And in terms of margins, this is a company that can have like a 25-30% free cash flow margin. So that is the steady state. And what I was trying to do before with Tesla is exactly the same reasoning. For Tesla, it's more difficult because there are many more moving pieces that are completely unrelated, like selling a car and selling megapacks. But since the company works as a single company and we essentially buy that aggregate, it is very useful to have an intuition of the steady compound rate and then apply a sort of margin that makes sense. And essentially do what Damodaran said. Damodaran says, okay, revenues to keep growing 20%, margins to essentially stay flat in the 13% range. And you see what you get as a valuation. And Damodaran says, under these assumptions that I underscore are very broad and very basic, we get essentially the current price. So if we invert, it's like making a reverse DCF, saying, okay, the market is implying Tesla to grow 20% and have a margin of 13%. And then after we know this, we know that under these assumptions, Tesla is fairly priced as of today. And then we need to think, how are these assumptions compared with the knowledge and the expectations we have? So if I tell you 20% revenue growth and 13% EBIT margin, where do you think the market is wrong?
I think just according to this, I know that 500 of this 700 billion is autos, and he has the margins at 10% here. So auto business only at 10% margin. I think we all assumed fairly higher margins than 10%. So already there, we should be above the trading price today. He has energy at 16% margins and reaching 80 billion. And the auto software, he assumes something similar to Microsoft, so 20 to 25% range for the margins and 40 billion. And then the robo taxis, he has some grand idea about the ride sharing partnerships, stuff like that. He has that at 30% margin and 80 billion in 2033. So that's his margin. Oh yeah, good. You just bring it up so I don't have to read from my notes. So yeah, I think the auto margins here, if you look at the profitability column to the right and the first row, you can see that he has only 10% for autos.
I agree. This number is very low,
and that makes up the majority of his outcome, which is why it's 13% operating margin as a whole. Because if we believe what Elon says, he says that the energy side of the business should be as big as the auto part of the business.
Do you
but then
think
again,
that can be also as profitable or more? Because that's the big question I have. Is energy is cool, but will it also be profitable?
Well, right now they're showing it's more profitable, above 20.
So you see, I think Emir is right underscoring, okay, Damodaran has very basic assumptions, assuming 10% EBIT margin on the key driver, and the key driver, 20% revenue growth is neither that strong assumption, given how good the company is. But the energy side, like, I'm starting to think that it could have very high margins, probably in the 2025, because let's go first principle. Like when they produce a mega pack, it is essentially the same battery of the Model 3 replicated n times, and that is just a box with a lot of cells, with a little bit of software, but there is no real dojo and running FSD. There is no personalization of the mega pack. It's just a box. So if you are actually very good at producing that box at scale, that can have very strong economies of scale. Well, what do you think about this? Because this is a component of the energy that so far is growing exceptionally high, and right now it has the gross margin that is even higher than auto. Potentially, this could be the growth driver. But this, so that's why I say, I think these numbers of the margins, of the net income being completely flat could be very wrong. But I'm trying to understand. Okay, I feel it is wrong, but why this should be wrong?
Okay, my fear with the energy business is that if we look at the energy business as a whole, according to Damodaran's market expectations, and I'm assuming those are from Bloomberg. I mean, he's usually very credible in sourcing. The energy market as a whole is only going to CAGR for the coming 10 years. So, I mean, we already know there are a lot of players in this space. So, like, where's Tesla going to eat this massive market share? Like, I'm not seeing it because I don't understand the market yet. But just looking at the market that's growing from 180 to 350 billion by 2033. I mean, and he's expecting Tesla to have 80 billion of that. I mean, I'm not seeing like how they're going to capture such a large part of the market.
Maybe the expectations are wrong.
Slide prior, Vince or Arnie, whoever is.
Sorry?
If you go to the slide he shows before this, like you can use the black one.
Okay, this one.
Yeah, so if you remove Crossroads comment so we can see the screen. Okay, so
sorry,
here he has solar energy market, including generation and storage systems, is currently 186 billion, expected to grow to 350 billion in 2033. That's 6.5% CAGR. That's really, really slow for something that people are hailing as the next coming of Jesus Christ or something. Like, people have huge expectations for solar and stuff, but I've looked at several sources and no one really has a solar market or energy market as a whole growing that much. So he has them at 80 billion of 350. I mean, that's a significant market share.
Yes.
I think here,
especially considering the China solutions and everything like that.
Damodaran is making the group of the energy business, but the energy business is solar plus energy. And I agree that the solar is relatively weak, but the battery side, in my opinion, is very, very, very strong. Like, you studied Brookfield, and you know how much weight they put on the energy infrastructure side. They said,
that's true.
Look,
that's true.
Look, governments need to be helped by private companies to actually build the entire infrastructure, because with the net zero goals, that means you need huge infrastructure for energy, which, by the way, means you don't only need to build solar panels, wind generators. You need a lot of energy if you really want to exploit them and you don't want to waste the energy that is produced. So I think Damodaran here is too conservative.
I think he takes the numbers from what he found, what was available to him. Because remember, the more AI compute that goes online, the more energy we have to consume, right? So every big company out there, I mean, I think last week Amazon bought a nuclear plant or something like that.
For the service, I expect them to gradually contribute more and more, like the App Store for Apple. having like a baseline margin for the auto. So like my intuition right now would be auto to be some percentage more than the classical automakers, with essentially the big revenues coming both from the very high end Cybertruck and the very low end the compact. But so let's say on average 13%, at most 15% margin for the auto, because they're very good at mass production, plus the services that so far is just barely at break-even, probably, since the gross margin is around 20%. So probably the net contribution is very low so far. But I expect this to actually gradually impact more and help Tesla go reaching the 20% margin overall as a company, with the services potentially being like that component that now is barely positive, but then gradually has like 30, 35, 40% margin. That's what I personally think. Like, what do you think?